Hi, I'm Patu from freefincal. You might have seen this mutual funds Sahi I ad during the World Cup matches. Two people sit and talk in a badminton court. One guy says, I'm scared of investing in mutual funds because if the market goes down, then I will lose money. I'm scared of the risk. The other guy says, yes, there are risks in mutual funds, but you should learn about these risks and then invest. So, and make sure you invest only money that you need after a long time. So the implicit interpretation of all this is that if you stay invested for the long time, the risk will reduce. This is wrong. Uh, well, again, that's what the industry wants us to believe. The industry wants us to believe just keep doing that SIP like a buck. Then over a long time, after a long time, you will become rich. Then they will show you nice presentations how last 15 years, 20 years, 25 years return has been 18%, 15%, 12%, whatever number. The 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 problem that most people fail to understand, and I'm fairly sure many people watching this video will still fail to understand, is that we have data, the stock market data available in India, recorded data is only 40 years. And the Sensex is not that Sensex, and Sensex is not even traded for 40 years. It started trading only in the middle of the 80s. So the recorded actual traded history is less than 40 years. It's about 35 years. And if you look at a 35-year return, obviously from point to point it will be very high. And if I ask how many 30-year returns are possible within this 35-year period, just a few. Just like what? Of 10, 20, 30 periods or so. So the available durations over which we can look at possible stock market returns in the Indian history is extremely small. I look at a small subset and cannot make assumptions. It's like going to Tamil Nadu and asking, did you vote for BJP? And if many people say they didn't vote for BJP, and assuming that BJP will lose in the Lok Sabha. That's the kind of thing. It's very unrepresentative because you're looking at one small slice in history, and you can't. I mean, if you're a product seller, yes, you don't care. You want to make people believe this is the best, and you want profits. But as an investor, it's our duty to go beyond these stupid ads and actually think. I mean, does stock market risk reduce with time? Does it reduce with the duration? The answer is no, and the answer is should not be found in Sensex. That's just too convenient. You have to look at something like the S&P 500, where it has got data from 1876. Daily data is available for the S&P 500 from 1876. I think Professor Schiller has got monthly data from 1876 for free in his website. I purchased daily data for S&P 500, I don't know, for a few dollars from 1927, and we're going to look at the rolling returns of that data in this slideshow. So I've calculated every possible 5-year periods available from December 1927 all the way to about May end 2019. The x-axis is the end date of the investment. So from December 1927 after 5 years, that will be the end. That will be the end date of the 5-year period. So that end date is shown in the horizontal axis. On the vertical axis is the return. So you have, that's the rolling duration, 5 years. There are 22,793 possible 5-year durations for the S&P. That tells you all possible periods. It has gone through wars, it has gone through depressions, it has gone through recessions, multiple recessions, it has gone through another war, Iraq war, it has gone through the dot-com bust, the 2008 housing crisis, everything, over all these periods. You should not take the average of the rolling return. I just did it by bad habit. Don't worry about this average. This is the standard deviation, how much the rolling returns fluctuate. I mean, if you know how to interpret it, you can. Don't take this actual number seriously, but notice that standard deviation will come down uh, as the duration increases. This is the maximum return, that's about 30%, or the minimum return is minus 23%. So in terms of risk, My measure of risk, the simplest measure of risk is the gap between the maximum possible return and the minimum possible return. Don't make any kind of assumptions about what probability, what is the kind of return I get, and so on. This is of course the S&P price index. The S&P total return index I could not get even for a fee. I could not get beyond 1991. You can safely add about 2% returns to this because of dividends, but you must also reduce about 1% from that because of the taxes. The US has got flat capital gains tax after 1 year, like India, but that flat rate will depend on your slab rate, on the US slab rate. So it's slightly more complex, but you have, roughly, if you remove 1%, you can be safe. That's a good estimate. Also, the US long-term inflation is about anywhere between 3 to 4%, roughly. It's about 3 to 4%. 4% is better to safer on the safe side because you have to account for lifestyle changes and so on. So, in terms of a real return, a positive real return, at least the stock market return should be 5% after tax. So that means if I just add 1% to this, that's after tax, but because dividends are excluded. So it should be at least 5% for them to for the US investor to get a positive real return. And look at the huge range over which the 5-year returns fluctuate. And this is over 10 years, again about 21,000 returns, 17% to minus 9% fluctuation. 15 years, 16% to minus 6% fluctuation. 20 years, 14% to minus 3% fluctuation. And you can see that the more recent returns are like the minus 3%. 25 years, 13% to minus 0.26% fluctuations. 30 years, 10% to about 2% range of fluctuations, range over which. Notice that 30 years you still have 16,491 data. That's a statistically significant number of points, approximately. I have to calculate it, but I can tell by inspection that's good enough. That's a large enough number set. 35 years, 9% to 2%. See, even over 35-year periods, I can't tell. The US investor cannot tell whether their return will beat inflation or not. They still get a huge range. That's between the maximum and the minimum minimum and the maximum possible returns. It's a huge range. The US investor can't be sure. You can never be sure that your return will beat inflation. The risk will go down. I mean, there will always be a huge spread in returns possible, and that is risk. That is a clear-cut manifestation of risk. That's 40 years, I think that's the last of it. Now, two more. Again, 9% to 2%. 45 years, 9% to 1%. Actually, the spread seems to increase a little bit. And that's 50 years, 9% to 2%. Even over 50 years, with about 11,000 data points, you still have about a 7% difference between the maximum possible return and the minimum possible return. There's absolutely no guarantee for the US investor that they will beat inflation, their inflation after their taxes. That is the reason why they try to have of course, their bond rates are fairly quite, bond rates are much less than inflation, even before taxes. That is the reason why many people try to diversify, they try to invest in emerging markets, the BRICS and so on. But the point is this, the singular point I want to make is, do not assume stock market risk will reduce with time. It will never reduce. This is just nonsense that these product sellers want you to believe. Don't get married to SIPs. Don't get married to the idea that equity will work all the time. You need to manage risk. You need to manage risk. This is my mantra that I keep saying in every video. Please learn to manage risk. I have a video on how to reduce your investment risk. Have a clear goal and asset allocation, and that's the first step. So I'll catch you again in another video. Bye.